On a Sunday night a couple of weeks ago, I was aimlessly scrolling YouTube to find something to watch, and I stumbled upon something I didn't expect.
December data showed persistent deflation for a third straight month. On a year basis, consumer prices were the slowest since 2009.
Grappling with a mounting debt crisis as investors ramp up calls for fiscal stimulus to boost the economy.
I got lost because I had just learned the day before that China's economy rose by 5.2% in 2023, so I decided to investigate further. It began that way, but the more I studied, the deeper I went, and what I discovered drastically changed my understanding of China's economy. China is facing a skyrocketing debt problem and a period of deflation, which might spell the end of its 45-year record of economic development and reform. And there is no easy explanation for why this is happening, but rather a combination of policy decisions, unexpected illness spread, market euphoria, lies, and mistakes. What began as an ordinary curiosity turned into the most thorough research I've ever done for a video. So let me walk you through the fissures that are emerging in every sector of China's economy and how they present a bleak picture for the country's future. Today, China is the world's second largest economy, but this was not always the case. The People's Republic of China was created in 1949 by Mao Zedong, a Marxist dictator. Mao structured China's economy after the Soviet Union's socialist policies. There was no private property or a market economy. Instead, skilled workers were assigned occupations, and their wages were set by the government rather than supply or demand. This was a significantly deficient economic model, but the fact that China was impoverished in the 1950s worsened the problem. China experienced a severe famine in 1959, which lasted until 1961. The precise figures for the famine are unknown, but contemporary estimates suggest that approximately 30 million people died in just 2 years. During his tenure, Mao was thought to be responsible for up to 80 million fatalities. Mao died in 1976, and Deng Xiaoping succeeded Mao as China's leader 2 years later. He led China for 11 years and implemented broad economic changes that would spark the longest and most successful period of economic expansion in human history. He began establishing special economic zones and allocating cities in which market capitalism could thrive. The first of these towns was Shenzhen, which is now one of the world's most powerful economies, serving as a global hub for trade, technology, and finance. However, for the time being, it was merely a testing ground for capitalism's ideals. Deng chose 2 successors before stepping down from his position as leader. Jiang Zemin was the first. He controlled China from 1989 to 2002, during which time the country made further economic progress. GDP growth surged, with the nominal figure reaching $1.2 trillion by 2000, and real GDP expanding at double digits practically every year. Deng's second requested successor assumed power in 2003. His name was Hu Jintao, and once again China experienced another decade of impressive growth. In 2011, Hu's last year as leader, they passed Japan to become the second largest economy in the globe, with a GDP of $7.5 trillion. 2012 was the year Xi Jinping seized control of China, and initially, he was seen as another market reformist. He desired free markets to play a bigger role in the allocation of resources. By 2015, the World Bank reported that China had reduced the proportion of the population living in poverty from 88% in 1981 to just 0.7%. Almost 1 billion individuals pulled out of extreme poverty in just 35 years. The progress that China has made is astonishing, but it is still a very thoroughly communist country. And in 2017, Xi began reversing some of the reforms, increasing state control over markets. In some ways, an essential part of China's economy is its state-owned enterprises. And in 2017, the National University of Singapore reported that they had more SOEs than any other country in the world. In 2019, more than 60% of China's market cap was from state-owned enterprises. And in 2020, 40% of China's $14.9 trillion GDP came from them. We'll talk more about these later in the video because they do truly play a vital role in some of the economic problems that China faces.
Evergrande. This is is on the brink of collapse.
China's stock markets are reeling with $6 trillion wiped off the value of Chinese and Hong Kong stocks since their peak in February 2021.
Today. In recent years, China has been afflicted by crisis after crisis, from the destruction of the jobs market as a result of overzealous COVID policies to the full collapse of a robust real estate market and the disappearance of almost $6 trillion from public businesses. These events did not occur by chance. They were the direct result of important policy decisions, market speculation, and greed. They convey the story of a crippled economy on the verge of the world's largest debt crisis, as well as the possibility of a return to stagnation in the coming years. And if you're enjoying the video, please subscribe. It indicates to YouTube that you want to see my new videos appear on your homepage suggestions. In 2020, the COVID-19 epidemic had a significant impact on the Chinese economy. The pandemic hampered consumer demand, production, and private corporate investment, causing GDP growth to fall from 6% in 2019 to 2.2%. They did, however, manage to grow, despite the United States' negative 2.8% GDP growth. How is this even possible? The answer actually resides in how GDP is computed. One approach is to add the entire personal consumption of the Chinese population, corporate investments, government spending, and net exports of goods and services. In 2020, China rapidly increased its investments, largely through state-owned firms, to offset the collapse of human consumption, all financed by massive debt. This will be useful later when we discuss China's current debt dilemma and how they are concealing some of their economic woes. China recovered in 2021, with GDP growing by 8.4%. However, when COVID resurfaced in 2022, Xi Jinping implemented the Zero COVID policy, a total shutdown of the country that reduced economic growth to 3%, aided by increasing investment spending. The Zero COVID policy permanently damaged many Chinese provinces, with many foreign businesses closing their China operations and laying off employees. The net departures of foreign invested enterprises were 63,000 in 2020 and 61,000 in 2021. China launched an innovative model for property developers in 1994, allowing them to sell flats before they were completed or, in some circumstances, before the projects began. One of these property developers was Evergrande. Their business concept, which began in 1996, was to borrow money from lenders and accept prepayments from customers. They then construct the property, sell it to clients, and utilize the earnings to repay their loans. And they were really effective at it. By 2021, they would have 1,300 projects in 208 Chinese cities, producing $76 billion in property revenue and becoming China's second-largest developer. However, this was accompanied by steadily increasing debt. In that year, their debts to Chinese banks and foreign investors totaled $35 billion. The problem was that China's real estate market was bursting at the seams. People had noticed the large increases in home and flat prices and were starting to assume that they would rise even further. This irritated Xi Jinping. Therefore, he decided to limit developers' borrowing in 2021. Essentially, this reform prohibited property developers from rolling over existing obligations into new ones. In other words, they needed to sell assets or raise funds to pay off their current debt. Evergrande began missing loan payments in late 2021, according to S&P Global, who put them in default on December 17th. Evergrande continued to sell assets to fulfill its obligations until 2022, before declaring bankruptcy on August 17th, 2023. But China's troubles aren't simply about property. According to Fortune, Chinese and Hong Kong stocks have lost $6.3 trillion in value from their top in 2021, and Tokyo has eclipsed Shanghai as Asia's largest equities market. Some experts feel that investors are withdrawing from equity markets due to problems in the real estate sector and escalating political tensions between the US and Chinese governments. Wait a minute. I began this video by remarking that China's GDP growth in 2023 was an outstanding 5.2%, a level not seen in the United States since 2000, with the exception of 2021. As promised, this examination into China's economy completely changed my perspective on economic data and how it may be manipulated or utilized to mislead people about what is really going on. The 5.2% statistic isn't what it seems, and after investigating behind the scenes, I discovered a country with a devastating and rising debt crisis, high levels of unemployment, and a loss of middle-class wealth, all of which are driving China into a period of deflation from which it may be difficult to recover. According to the IMF, China's national debt-to-GDP ratio stood at 41% in 2014. By 2022, their debt had grown to $14 trillion, accounting for 77% of GDP. That, however, was only the beginning. China not only has a considerable amount of official government debt, but it is also estimated that there are trillions of dollars in secret obligations. The central government of China, like most governments, imposes budget limitations on local governments to limit how much they can spend. However, Chinese provinces have found a way around this by establishing a local government finance vehicle. They're essentially a type of business corporation that permits local governments to skirt their budgets and incur more debt than they're legally permitted. As you can think, the information on this is extremely hazy. However, one estimate from Ganshu places overall liabilities at $11.3 trillion in 2022. While Bloomberg puts China's total debt-to-GDP ratio at nearly 300%. According to Ganshu, nearly one-third of these financing vehicles were unprofitable in 2022. So we can start to see what's really been driving the Chinese economy: debt. The problem with becoming overly dependent on government investment for your economic growth is that it starts to hurt output with poor investments. The GDP return per Chinese yuan of extra debt has been declining for years. In other words, China is driving its growth by borrowing money and making lots of investments. But their wasteful spending on these investments means that they're investing in a lot of projects that won't give the country any money back. 2/3 of corporate debt in China is held by state-owned companies, many of which are unprofitable and inefficient. Some of them are state-owned property companies currently taking huge losses in the property crisis. While headline GDP tells the story of a slowing but continued growth, at the consumer level, it's a totally different situation. Bloomberg reported recently that a deflationary situation is forming in China, with the consumer price index falling for 3 straight months. It's being caused by weak demand at the household level. For starters, the real estate collapse has basically reversed the wealth effect that households felt for many years as property prices rose. With 70% of household wealth in real estate assets, it's had a big impact on consumer confidence. Less spending has led many businesses to slash their prices to sell their goods. A general decline in prices might not seem all that bad, especially if you live in one of the countries that have recently experienced a massive rise in the cost of living. But deflation is actually viewed much worse than inflation because lower prices mean businesses make less money. So wages go down and people get laid off, so households have even less money to spend, and the cycle worsens. Deflation also makes the current debts owned by households, businesses, and governments bigger in real terms. Households, for example, might see prices and wages go down, but the amount of the debts they owe will stay the same. So it looks like those debts are bigger figure compared to their income and therefore relatively harder to pay down. The bright lining in all of this is that almost all of China's debt is state-owned. State-owned banks lending to state-owned businesses or local provinces with their own currency. So the government can print its currency and cover those obligations, a very inflationary approach. But that's the least of their worries right now. Ultimately, while this was an interesting deep dive, official economic data, including debt estimates, have been patchy at best and completely unreliable at worst. The Economist Intelligence Unit investigated how China only recently changed how they measure some parts of GDP to match the agreed best practices. So the real story of the Chinese economy could be very different from how it looks from the outside. An enormous amount of research went into this video, so if you liked it, the best way to support me is simply by hitting the subscribe button. Or even better, check out some of my other videos here.